In the age of e-banking, having a bank account has never been easier. But there are rules of engagement that go with it. There are do's and don'ts that ensure you get the most out of your banking experience. We've listed some habits you need to ditch immediately because they are a disaster for your bank account. Number 10. Not reading up on financial material. How many questions can you answer right on a financial quiz? According to a study, only 18% of 18 to 26-year-olds can answer 4 or 5 questions correctly on a 5-question quiz. You've heard the statement, if you think education is expensive, try ignorance. The same is true when it comes to money. If you think reading up on money is a waste of time, then your bank account will hemorrhage a lot of money. There is a lot of financial material out there. You can find some of it for free on financial blogs or invest a small portion of your money for books on money. This is a better use for your $20 than a clothing item you won't wear more than once. With these materials, you can keep coming back to them to refresh your financial understanding. You need to know about stocks and inflation and what that means to you as a banker. Follow economic policies and reforms, especially those that have to do with insurance and retirement benefits, so that you have that covered. Number 9. Sticking with the wrong bank. Loyalty is not the name of the game when it comes to banking. You shouldn't just pick a bank because it's where your father, grandfather, great-grandfather, and entire lineage kept their money. Research for yourself. There are so many banks springing up, and most of them come with offers that make sense for you. Look up what the bank charges are like. Are they charging you at every step of your banking process? What about their ATM? Are there fees whenever you go to withdraw? Do they have one near you, or do you have to drive miles before you get to one? Can you access their customer care services easily? Do they offer you any benefits from long-term membership? Try out another bank before closing the chapter on the wrong one completely. Take notice of their charges and then make an informed decision. Number 8. Accepting bad checks. Depending on your bank policy, you may have to deal with the fees that come with accepting a bad check. If you are going to accept a check, make sure the person offering it to you is good for it. There are telltale signs you can look for, like a check number with a number below 125 or with a handwritten number. You can also call their bank to make sure their account is good for it. It's also a good practice to wait about 30 days before spending that money to make sure that they draw funds from the checking account. Number 7. Overdrawing your account. Overdrawing your account means that you are going beyond what you have in your account. Some banks do allow this, and it acts as a short-term loan. You could have made a purchase or a charge that hadn't registered yet, and you could go on to make another. This is another kind of debt that you would owe the bank. If you are the one feeding your bank account from your various streams of income, it is safe to assume that you know how much there is. The easiest way to avoid such situations is to live below your means. As much as possible, try to do things yourself, like cooking at home, or making your own house decorations, and mowing your own lawn, or sewing your own clothes. Don't go out impulse shopping, and when you see an item that you would love to have, give yourself time before you make a definite decision on it. Do you really need a new coffee table? What's honestly wrong with your current dresser? Stay away from such big money commitments, even the small ones, till you have reviewed your financial statements. Number 6. Making minimum payments with your credit card. This simply means you haven't paid off your credit card debt in full. Most banks allow you to pay about 1% to 3% of your full balance. The banks don't mind because they get to benefit from this when they hit you with the finance charges. Making minimum payments on your card only makes a small dent in your debt. With the interest, you barely get to pay off what you should. The balance left will grow because of compounding, and you won't be able to get out of debt as quickly as you had hoped for. Consider going without your card for a while so that you are not adding any more debt with other purchases. Make it a habit to pay your cards off in full. The first time around will be hard, especially because making minimum payments seems more convenient. But think more long-term and do it. When you have no more credit card debt, you'll be glad you did. Number 5. In-app purchases. We all have different forms of entertainment. For a large number of us, it's games. Mobile games are a great way to kill the time when you are waiting for the movie to start or when you are in line hoping to get to the counter soon. And it might seem like just $1 a week, but it will snowball into an amount that will break your account. You don't need to commit your account to every form of entertainment you seek to have. You can have some free mobile games that won't trap you up with in-app purchases. These are not in-app purchases, but are also worthy of mention. Take note of the subscriptions you have. You don't need to keep up with all the TV streaming sites, delivery services, magazines, and whatnot. Allow your account to breathe and round up the money like it should be doing. Pick just a few that you really enjoy. The way to know this is to find which ones you consistently use each week. Number 4. Ignoring your credit score. Your credit score is something you rarely think about till you need to buy a car or a house. If you have ever needed a loan, you know how vital a great credit score is. Unfortunately, this is one of the things people ignore till the last second. But you can aim to get on top of your credit score. Your credit will influence how much you end up paying for services and utilities like insurance. And you need insurance. Life is completely unpredictable. Take note of the things that lower your credit score, like late payments or missing payments. You can automate this so that you never miss any payment. Look at your bank statement and see what you can do better. This is also something people usually don't want to do, but it is better to rip off the Band-Aid and get the help you need rather than letting a wound fester. There are free apps that can help you with managing your credit score, like Credit Karma. Number 3. Avoiding making a financial plan. Those that fail to plan to fail. This truth applies where your money is concerned too. If you don't plan for your money, it will ooze out of your hands faster than you can say payday. Without a plan, anything goes. That means you will not have a valid reason to turn down your friend's trip or baby shower event. You won't have the restraint to walk away from that cool leather jacket, or go home instead of turning in at that new restaurant that opened a few blocks from you. A financial plan will keep you focused and enable you to account for your money. Write down your money goals, your sources of income, and your daily, monthly, or annual payments. Make provisions for insurance because you are not invincible. Set a savings goal and leave some room for fun. It's one thing to make a plan, it's another to keep to it. So make sure you follow your financial plan all the way through. Number 2, not tracking your spending. It's important to know where your money goes so that you can fix the little leaks that drain it. Unfortunately, about 65% of people don't know how much they spend in a month, according to a survey taken in 2020. How often are you eating out? How much do you spend on coffee? Are there cheaper options that will allow you to enjoy the same benefits while helping you save your dollars? Once you see how much money you lose over small things, you will start to reconsider. You won't buy snacks whenever you see them. You might consider using public transport over your own car. You'll be able to see where you can save and make the necessary adjustments. You should track every dollar and penny because they pile up and total up in thousands of dollars. It might be hard to do it manually, so get an app on your phone that you can fill in on the go, like Money Manager. If you are prone to overspending, have a friend hold you accountable or regulate yourself with an allowance that you can't break. If you enjoyed it so far, please like this video and leave a comment. What is your best way to save money? Number 1. Not saving. The purpose of your bank account is to save money for yourself. So if you're not saving, your bank account is facing a disservice. According to a poll conducted on millennials, about 69% have savings accounts with less than $5,000 in them. This is a good start if you're one of the 69%. If not, then you are just keeping yourself financially unstable a little bit longer. Get a savings account. It is hard to always remember to save, so you can have it automated. As soon as your money hits the account, your savings will be cut off. It also helps to have an emergency fund on the side so that you know you won't have to draw from your savings account. It helps if you have a savings goal. This will keep you focused on saving till you hit the goal. Saving is a discipline, so don't think you will have $1,000 when your salary increases. It starts with a little. Save $5 or $10 if you have it, and cultivate the discipline. You could also consider having a piggy bank as a visual reminder of your need to save.